Hello traders, in today's video is going to be another theory video. We're going to be going over what to do during periods of high volume and high open interest and some little trading techniques that I'm going to reveal to you guys. Let's dive in. Okay traders, I want you guys to look at this example here. So what we see in this simulated example is we have an offer price 13,000 and a bid price of 12,999. There are currently 250 Bitcoin bid and 200 Bitcoin offered. You know, market buys are happening, market sells are happening, people are getting into positions. Let's assume that open interest is now rising. So people are hopping into positions and you see this happening. Then what we see is, what ends up happening is, let's say that all of the Bitcoin offered gets bought out and price goes above 13,000, right? But there were a lot of market sells here. So let's get a value. Let's say that in this range right here, where price is just bouncing off of 13,000 and 12,999, two large limit order book wells, we have transactions here of, let's say, 400 BTC. So we know that 400 BTC have been transacted. And again, let's assume that all of that Bitcoin was open interest increasing. We have 400 Bitcoin worth of new positions. Got it? Cool. So that means we have 400 BTC long and 400 BTC short. Got it? So now look at this right here. Let's say that this is price. I know this isn't like the most beautiful drawing, but it's going to prove a point. Let's say that this price right here is 13,000. Price begins to rise, you know, because we saw that what ended up happening was there was a large amount of buying interest at 13,000. But what we know is that there was an abundance of people entering at around the price of 13,000 right here. So we know that this is just incredibly likely to provide very strong support because of just how much open interest was increased. So what you're going to see, what kind of trading pattern are you going to see? Well, there are a lot of different ways that this could play out, but typically what's going to happen is this. You could see price begin to duck back down here, and the reason that happens is anyone who went long here, let's say that everyone had entered here. Anyone who had long here might begin to take profit here. And when one guy begins to take profit, other people want to lock in their gains. They begin to take profit as well. Then price comes up to a point where all of those longs had taken profit and a lot of shorts who had entered here, guess what they did? They're holding their unprofitable positions. They're not budging, right? Let's say that open interest is just kind of flat, meaning that shorts aren't really budging and the longs are just kind of taking profit. And new longs are entering, of course. So what ends up happening is price isn't able to go below 13,000 because that would allow too many shorts to become to get out at break even. So what price ends up typically doing here is price will come right back up, go a little bit higher here, go a little bit higher here, and then it begins a trend. And now these shorts are very, very, very trapped. Now let's make this a little bit more complex. Let's say that we still know that a lot of shorts are trapped here, but on this move, what can sometimes happen is we see a lot of shorts actually adding to their positions, adding to their losing positions. And when we see them adding to their losing positions, I know one thing's going to happen. First of all, if a lot of shorts start adding to their positions, price might start coming down a bit, right? Because a lot of these shorts who had entered here, again, are adding. Then what you're going to see is these positions, these short positions, are highly leveraged. They're using a ton of leverage and their liquidation prices around here. So what you're going to end up seeing is one of two things. Either price goes up in kind of like a slow bleed, just slowly goes up, and then it just shoots up like that. Or price just shoots up because there are just so many leveraged longs, so it kind of goes like this, blah, 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 nothing really happens, then boom. Why does all this happen? Let me do a quick recap of what in the world just occurred here and why did it occur. Traders are like, oh my God, you know, what's going on here? Well, let's rewind the tape, you know, rewind the tape. So we see that a lot of people entered here. The majority of positions had entered at one critical point of open interest. Now what we see is that price goes up a bit and then longs begin to take profit. The shorts are still trapped because price doesn't go below the point that many shorts had entered. Then what we see is price begins to go up and the shorts get scared and they kind of want to average their positions or do a martingale strategy. And a martingale strategy is adding to losing positions until you become profitable. Or it's entering with larger sizes to go beyond break even for a day or something like that. But let's do it with unrealized, not realized positions. position profit loss. And then shorts begin to add to their positions here, and we also might be able to see some longs taking profit as well. But basically shorts entering, longs are exiting, so that's the sell-off, of course. Then that sell-off just kind of stops, and the sell-off stops here because anyone who wanted to add to their short position kind of just stopped, and they're just kind of hoping the price goes lower to get them out of their unprofitable position. And then what we see is a flat price movement. The shorts are probably saying, please don't rise, please don't rise, please don't rise, please don't rise. And then what does price do? It slowly bleeds up higher, where some shorts might still be adding, and then price just erupts higher. That's scenario 1. Okay, let's go over scenario 2. Then I'm going to transition to an actual chart, and this won't be hypothetical anymore. Okay. So here's another thing that can happen. Remember, same exact scenario. Everything here is the same. Price broke out of 13,000. Another thing that can happen is, this is going to look a little bit weird on this kind of axis, but bear with me, okay? Pun intended. Price goes up a bit because, we see that initial buying from 13,000. Price is just chilling up here. Then price goes below 13,000. I know it looks weird here because it's it's below the axes. Price goes below 13,000, let's say to like 12,980, and a lot of shorts just rush to take profit. And that's why you get that wick. So sometimes when price wicks, sometimes that's, stop losses, liquidations getting hit, of course. But a lot of the other time, what's happening is price wicks down in a candlestick because it's a burst of people taking profit, which pushes the price back up in the other direction. Because if price wicks down and is there for like 20 seconds or 10 seconds, a lot of shorts take profit, wicks right back up, and in a 1 minute candlestick, you'll see a big wick. Got it? So then we have that wick right there, and potentially that wick also took out any longs who were using tight stop losses, which furthered the sell-off. And then we see price just begin to trickle back up higher, and a lot of shorts who are still in their positions here are like, man, I wish I had exited. And then price gives them a little bit of hope here. Price might give them a little bit of hope here. And then, of course, it can't go any lower because there are too many shorts who want to buy back here. Too much demand at that area. Too many trap shorts means the price can't do that. It just really physically can't. So then price goes a little bit higher. And then at this point, let's say that price might be just going higher because it's floating away from trap short positions because these guys are trapped. And then price just kind of maybe doesn't do much here. And then in this scenario, let's change the entire game here. Let's say that now longs are becoming overconfident. So a lot of the longs here, let's just surmise that they hadn't taken profit. Okay? So all the longs are fresh. They're all in profit. They're like, yay, we're in profit. All the shorts are like, no, we're all at a loss. With all the people who entered at this horizontal line. Got me? Again, let's say that none of the shorts are taking profit. Just some took a loss down here. Price begins to trickle down. Some of those longs are going to lock in profit. They're scared. I don't want price to go down lower in my 10 BTC long position to go unprofitable. That's terrifying. They take profit. Then other longs take profit. Then more longs take profit. Then more longs take profit. And then, we get that kind of weak move up. But that weak move up doesn't really do anything because no one's really interested in buying here. Shorts are still waiting to buy back lower. They're not interested in buying now. So price can't rise because of that reason. And new longs aren't really entering here because this looks pretty extreme, this large bearish drop-off, right? Why do I want to buy after this large bear move? It looks like it's going to keep going. So not many people are buying, which perpetuates the move lower. Longs, take profit, take profit, take profit. Longs are taking profit. Now, a bunch of longs are in a loss because we're below horizontal line where we saw a significant jump in open interest for longs and shorts, And then the whole game flips here. The whole game flips such that because we know that a lot of longs are now the losers and the shorts are the winners here. So now what's probably going to happen is price could try to go higher, but then we get the same scenario where when price tries to go a little bit higher, what ends up happening is there are so many longs that are holding unprofitable positions that they just have to sell it back lower here. And then what we see is that potentially this first move right here that I didn't explain, it didn't go too far down. It didn't go too far down because a lot of shorts wanted to take profit and buy back, which caused price to go back up. But price can't go back up such that enough longs are able to get out of their positions at break even or at slight profit. And this is scenario 2. So this is two scenarios to tell you the difference between the two. The first one, guys, was one in which the shorts were just not having a good day. A lot of them had entered at the horizontal line. It didn't go well. Price tried to trick them, went down a little bit, and maybe they added to their positions. They were hoping that they could get out of their average position at break even. They fail. Then price goes up higher, and then we get a large amount of buying. We get a large amount of buying that begins an uptrend because so many shorts, stop losses, liquidations, and panic exiting is occurring. Okay. And then in scenario 2. Scenario 2 is complicated. I'm not going to lie. It's a lot more complicated than scenario 1. Which is just kind of a short squeeze. Scenario 2, we see a stop loss under the longs, some shorts taking profit on a price wick here. Then price comes right back up higher as just too many shorts wanted to take profit here, a large amount of demand, which pushes price higher, of course. And then maybe some shorts add here. And then we get that thing that I was talking about with longs rushing to take profit. Because when you have a lot of profitable longs, that's not a good thing to be long. That is bad. If you have a bunch of profitable longs and you are long, you better be the first guy to take profit. If you know for a fact that no other long had taken profit, they're going to begin to take profit, and you don't want to be the last guy taking profit. That'd be like terrible here. Minimal profit or major loss, of course. So this is the kind of pattern that can happen here when a bunch of longs want to take profit. And then too many longs wanting to take profit, price goes lower. Any long who hadn't taken profit is now trapped. So the second situation is more complicated, but it is something that can occur as well. All right. Let's go over to the graph. Okay, my brightness is it's hard to see because the sun's hitting. It's very, very hard to see. All right. I'll just have to imagine the open interest. Well, what you're looking at, if you can actually see it here, is the aggregated open interest. This is a combination from Coinalyze of these exchanges here. Got it? So this isn't just one exchange's open interest. This is an open interest of 2.6 something billion. No, 2.3 bill. And it aggregates open interest from multiple exchanges. Okay, so what we can see here is that we have a pretty clear open interest increase, right? Open interest is here. We have a pretty clear open interest increase as the price was ranging up here. Well, how does that play into what I was talking about before? Well, what this means is that we have a large amount of positions entering here, and then this sell-off could have been, a lot of longs, stop losses and liquidations getting hit. Maybe it could be some earlier longs taking profit, but I doubt it. But this sell-off occurs, maybe it's even shorts entering, but it looks like open interest decrease, which would mean it's likely longs getting massacred on a long squeeze. So really, to tell you guys what was happening here, let me actually go back to the drawing board, because I think that's a great way, a really, really great way to do that, okay? Let's go over it. So let's say that, this is not going to be drawn to scale in any sense, but I'm going to start showing you guys a visualization of what happened around here-ish. We're going to begin around here, okay? Around here. So price shoots up, right? Price shoots up to here. It's just chilling up here. It's just chilling. And then it begins to range. And in this range, we see longs and shorts entering. Open interest is increasing, da-da-da. But then what we see is that we get this sudden move like this, and that move actually liquidates and stops out a lot of longs, right? And then price is just kind of unable to go any higher, because if it does go higher, any unliquidated longs are probably just going to want to take profit, So that's kind of what's keeping price lower right now. And then what we see in the current scenario, right now in the past few hours, is this. We see something that happened like this, where price went up a little bit, then went down in probably maybe a stop loss hunt or a liquidation hunt, and then went back up. This is a terrible drawing, but I hope you understand what I'm saying here. Kind of is ranging here, and now it recently just went up a little higher. So what could be happening here is that, of course, longs are losers here, because all the longs who had opened here are in a loss. That's just a fact. Even if they had added lower, they're still in a loss probably, unless they added major. Now shorts are losers here, right? Shorts are losers here because they had entered into the range here. Price goes up and traps them. So what happens when we get this kind of scenario? When we get a lot of open interest increasing here and a lot of open interest increasing here, losing shorts, losing longs. Well, what tends to happen, let's go back to price. Yep, you can see slightly increasing open interest here. Well, what tends to happen is that the larger side loses, okay? The larger side of losses here are longs, right? I can see that there are clearly a lot more trapped longs than there are trapped shorts, which makes me more bearish at the very moment. I'm not saying the price is destined to go down. It could do anything. but I think it's more likely probability-wise that price goes down. And I think the probability that price goes up is just a little bit lower. But if price does go up, that could obviously just happen. Because if I think that there's a 2/3 chance price goes lower, 1/3 chance price goes higher, 33% of the time still price goes higher, But what tends to happen in these scenarios when we have two losing sides is this. Price wicks. Price will wick to one side, and that'll be the final move to that one side. So what I mean by that is if price is to go higher, it's going to wick up. And it's going to wick up for two reasons. One, it's going to wick to liquidate the losing shorts, and it's going to wick to not give enough time for the losing longs to take profit or to take break even. That's why it wicks. So it's going to wick up to here maybe, and then maybe it comes back down. Lower probably if it does that, and we'll probably break 12.7K. Or what we end up seeing, which could even be more likely, is price rejoins this range and makes the shorts not lose as much. And if it rejoins the range, it could kind of just chill out here for a bit, blah, 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 and then maybe it goes lower. The only scenario I think where price is actually going to end up going higher is if you see this. I think that the only way that price could really go higher is if price were to see a large increase in open interest at around these prices, indicating that a lot of shorts are entering, and we get enough shorts entering such that price just has to go up higher because of the quantity of trap shorts lower. Then I would say, yeah, price is probably bullish, but like I had said, price is a little bit more bearish right now because of the analysis I had given. Yeah. Okay, so that's going to do it for this video. I know that this was kind of all over the place, but let me just recenter it so I can make it a little bit more clear. What we talked about was, first of all, I introduced the aggregated open interest indicator from Coinalyze. I love it. It's really great, and it's free. It's great. Another thing that we talked about is what tends to happen in tight market ranges when we see a large amount of open interest increasing. Now, this is not a tight range, of course. What I mean by a tight range is like a few dollars. When you see like 400 Bitcoin transacted in a very tight range, what can tend to happen is that range can become a very crucial point of support and resistance. And that's where we saw those two scenarios that I gave in the earlier examples in this video. And then I put it in a real example. And in that real example on the current price of Bitcoin, that I don't know where Bitcoin's going to go, I was just giving my 2 cents on the positions of both sides and the losing positions of both sides, more specifically. We have losing longs up here and we have losing shorts down here, but we probably have more losing longs than losing shorts, which means there's probably more potential sellers than there are potential buyers, if that makes sense. That's going to do it for this video. You should keep an eye on this. Keep an eye out on whenever price isn't really trending much or price isn't really moving much, there's a large increase in open interest. That point can become crucial because if price is able to go above that large point of increased open interest, price will tend to keep on going higher because it's trapping those shorts lower. If price is able to fall right after a large increase in open interest at a tight range, price tends to continue to fall because there's a large quantity of longs that are trapped at that large increase of open interest a little bit higher. So that is how I personally use open interest in conjunction to find trap traders, to locate losing longs and to locate losing shorts. Okay, I hope that this was helpful. And if you want to learn any more, you can pick up my course, Master the Market, or you can private message me and go from there. Happy trading.